So, they have initiated an outperform rating on both the counters, and they've said that the power financing companies like Power Finance Corporation and REC are the leveraged power bet plays. Now, the target price for PFC is at 620 rupees and for REC is at 653 rupees. Both stocks from yesterday's previous close, it implies a more than 20% upside for both the counters, higher on PFC side. And this is despite the run-up both the counters have seen more than doubling and tripling of their stock price in the past year itself.
Right.
What are one of the reasons?
Right. So they're saying that both REC and PFC are the most preferred stocks in the power play. What they're saying is that they see volumes growing at around $125 million, yet the valuations remain very attractive because they are within a range of P of 8 to 10. Now, the market cap for both of these companies, REC's market cap stands at 1.42 lakh crores and PFC's 1.66 lakh crores. What they're saying is that in the last 6 years, 100 gigawatt of power was generated. However, in the next 6 years, they're expecting more than 300 gigawatt of power generation, and power demand will continue to surprise the upside growth. And this could be 1x of the real GDP in medium term in India. And intensity of capex cycle could be 2x compared to the last one based on the current capacities. They're also saying that a combination of lower utilization in renewables, which are 2x more capital intensive as compared to the thermal one, will intensify this power generation. But Mihika, what about the valuations going forward?
Yes, so going forward, the valuations do remain in the lower single to lower double-digit numbers. But one of the pointers that the Bernstein does point out is the lower non-performing asset risk. Now, these companies typically lend 70% of their incremental lending to government entities and 30% to private renewables. Now, historically, risk has always come in more from the private lending side. But when you talk about renewable loans, they have a lower chance of default, according to Bernstein, and this is due to three factors: short execution cycle, back-ended capex, as well as projects being backed by the power purchase agreement, as well as lower fuel risk. And they've also spoken about the benefits of provisional write-backs, Mahima. What about that?
Absolutely. So in 2017, the government had released an order of 34 companies which were distressed because of thermal plants, and majority of the loans were given by PFC and REC. However, now, because of the shortage of power generation, these distressed companies are now picking up, and their capacities have grown from 40% in FY18 to 70% now in FY24. Now, 9 out of these 34 plants, the distressed problem was resolved in 2017, and 6 are in pipeline for NCLT resolution. So, the biggest contribution to all of these power companies has been Adani Power, and a new thermal plant is being built at 100 million. Basically, a new power plant takes around 100 million per megawatt to be built, but buying of these distressed plants is almost a fraction of that. So basically, provision reversals in all of these will help aid PFC and RFC both together.
Yeah, and this was also seen in REC's FY24 financial performance, where revenues were boosted mainly because of over 13,500 crores of provisional write-backs, out of which 710 crores came in Q4 itself. Now, what a provision write-back basically is, provisions are set aside for potential losses on specific assets, and when a company write backs these provisions, the expense is reversed, and this could boost the company's profits. Now, REC specifically, management has stated that they plan to become a zero NPA company by FY25, and they've also added no fresh NPAs in the last 8 quarters. And management lastly has stated that they expect around 1,500 to 2,000 crores of write-backs in FY25, as 2 Maharashtra projects are expected to be resolved in FY25. So that's what we had on the Power Financing Corporation company.